Hey David, thanks for the call this afternoon. I appreciate the introduction, and I'm happy to have the opportunity to run some numbers for you, see if this refinance makes sense. I've pulled together a couple different options, basically using the 370 as the value, just a placeholder, obviously, until we get an actual appraisal. But from our conversation and the recent comp in the neighborhood, sounds like 370 would be realistic. So at 370 and consolidating your first and your second, you're just right about at 90% loan to value, maybe a little bit less. But anyway, that 85 to 90% is going to price out the same. Again, anything over 80% is going to have mortgage insurance or prepay the mortgage insurance to get rid of it. So that's part of what these options are on paper. So you could see that that you got a couple different ways you could structure it. If you can wrap your mind around taking a slightly higher interest rate and prepaying the mortgage insurance, that'll lower your monthly payment, or you could pay that out of pocket as a fee and have the lower rate. But I'll give you a breakdown here, side by side comparison, and you can make that decision and see what's going to make the most sense. No matter how you slice it, there's good savings available. 30-year fixed loan, consolidating your first and second, you're saving right about $500 a month from your current loan, dropping the interest rate obviously, and then not having the second to deal with. So let me just jump into this here. Let me know if you have any questions or if you want to see other options. I'm happy to run those as well. And then of course the next step would be to get an application from you and start moving forward. So let me just go line by line here on these. So the first one, 30-year fix with no points, so no origination, no discount. And this is with prepaid mortgage insurance. So basically what you're doing would be a loan amount of 325. That's your current first plus your second, and closing costs and prepaids being rolled into the new loan. So the idea here would be zero cash to close. And you can structure that however you want. You could keep the loan amount the same as what the current payoffs are and bring those closing costs and prepaids to closing, knowing that you're going to get reimbursed from your current escrow account after closing. And you're also going to have 1 month of no mortgage payment. So if we close in towards the end of May, your first payment would be due July 1st. So oftentimes people want to bring a little bit of money to close in order to not add that back to the loan amount. But we could structure it up however makes sense for you. So appraised value 370, loan amount 325, equity remaining in the home for 45,000 based on that 370 appraisal. So 30-year fixed with no points, right at 4.25 today. And again, so that 4.25 is slightly higher than market, and that's done intentionally to prepay the mortgage insurance. So sorry about that. That's done intentionally to prepay the mortgage insurance. So your payment would break down as follows. So 1598 principal and interest, your property taxes right about 376 a month, and then home insurance at $50 a month, making your total PITI payment at 2025. Closing costs, all mostly third-party stuff. The bank does a small processing fee, but you got your title, escrow, and appraisal, right about 2,700 in closing costs. And then you got your prepaid items that go into your escrow account. A few days of interest. I'm using the 15th as a placeholder. If we close at the end of the month, it'll be 2 or 3 days. If you close at the beginning of the month, it'll be 20, 25 days. Just depends on which day you close. But using the 15th just as middle of the month. So could be a few more or a few less depending on when we actually close. 4 months of property taxes to go into your escrow account, plus 2 months of home insurance. So right about 2,100 in prepaids. So 325 loan amount, closing costs, prepaids, and then the aggregate there of your first and second. So basically zero cash to close. You actually get $140 back on that scenario. So that's one option. The second option here is to do so 30-year fixed with prepaid MI at your current payoff. So everything's the same as the first scenario, except for you're bringing $4,830 cash to close in, which would be covering your prepaids and your closing costs. So basically the loan amount would be 320 instead of 325. Same rate, payments a little bit less because you're financing a little bit less. Closing costs are all relatively the same, prepaids the same, and about 4,800 cash to close. And third option here, I just want to throw this one in. I mean, this is where we can get a little bit more creative with the mortgage insurance. Um, you're taking a lower interest rate, so the market rate today on a cash out refinance, cash out because you're consolidating a non-purchase money second, so that second loan is being rolled into the first, so that's considered cash out. So rate today is 4% on a 30-year fixed with no points. Now this is paying the mortgage insurance out of pocket as a fee, so not taking a higher interest rate and offsetting that cost, but paying it out of pocket as a fee. And I've highlighted where that is, so it breaks it out. So 370, 325 loan amount. So this would be rolling some of the costs into the loan and then paying some out of pocket. It's kind of a split between the two. And you could do it either way. You could pay all out of pocket or all into the loan depending on the appraised value. So 370, 325 loan amount, 4% on a 30-year fix with no points, 1551 principal and interest, 376 taxes, right about $50 a month for insurance. It would be 1978 on the monthly payment, PITI. Closing costs, all the same except for we're paying upfront the mortgage insurance right now. So that MI would be 4128 out of pocket. So that adds this to the closing costs. So you're looking at 6,800 in closing costs, and prepaids 2,100 and 3,900 cash to close. So basically the 4128 is saving you about $50 a month between the first option here at the 4.25 and this option at 4%. So $50 a month. Basically 82 months to recover the cost. So six years and 8 months. So you can make the decision. My opinion would be just to take the slightly higher rate. But the reason for putting them side by side is a lot of times you see marketing for rates and billboards and all that kind of stuff, but doesn't really give you the adjustments and what exactly goes into the rate. So wanted to let you know that 4.25 was actually picking up that 4,128 in that rate. So you're not paying it out of pocket. Adds a little bit to the monthly payment, but you're not out of pocket, and doesn't take 8 years to recover the cost. So let me know what you think. If you're wanting to see other options, I'm happy to run some different scenarios, but thought this would be a good starting point. Definitely savings available, and next step is to make application and get moving forward. Talk to you soon. Thanks.